Picture a single valve, sitting in the basement of every building on the planet, connected by hidden pipes to every car, every plastic bottle, every fertilizer bag, and every airplane seat in existence. Turn that valve a quarter tighter, and within weeks the price of your groceries moves. A war becomes cheaper or more expensive to fight. A government on the other side of the world either stays in power or falls. Nobody outside a handful of trading floors and palace offices ever sees the valve itself. You just feel it turn. This is the story of the substance behind that valve, and of exactly who gets to touch it. Here is the fact that reframes everything else. A barrel of crude oil sitting underground is worth close to nothing by itself. It becomes valuable only once someone builds an entire chain around it. The rig that pulls it up, the pipeline or tanker that moves it, the refinery that splits it into fuel and plastic and asphalt, and the legal and military machinery that keeps every link of that chain standing. Ownership in this business rarely means owning oil, it means owning a piece of that chain, at the exact point where you can charge everyone downstream for the privilege of using it. Picture crude oil the way a doctor pictures blood inside a body. On its own, sitting still in a vein, blood does nothing useful at all. Its entire value comes from circulation, from arteries and capillaries carrying it under pressure to wherever the body needs it next. Cut the flow anywhere along that system, and everything downstream starts failing within hours, even though nothing physically changed about the blood itself. Crude oil works the same way, and it's exactly what powers that valve from a moment ago. The liquid sitting underground is inert. The pipes, ships, and refineries built around it are what turn a black puddle into the pressure behind the valve, running your car, your kitchen, and your national economy. Remember that valve, and the plumbing feeding it. You'll need both again by the end of this. Your entry cost in this business depends entirely on which link of that circulatory system you try to own. At the smallest end, a shallow onshore well in an established American field can be drilled and completed for a specific range, somewhere between $500,000 and $2 million. Step up to a modern horizontal shale well, the kind drilled across Texas's Permian Basin. You're looking at somewhere between $8 and $12 million, once drilling and hydraulic fracturing are both included. Push further, into deep water hundreds of miles offshore, and a single well can run past $100 million, with the drilling rig alone costing several $100,000 a day just to keep on site. At the very top of the scale, national governments simply own the resource outright. Saudi Arabia's state oil company controls reserves several times larger than the 5 biggest private oil companies combined, with no entry cost at all beyond the state's own existence. There's a fifth entry point too, unique to a handful of countries and especially common in the United States, owning the mineral rights themselves. In most of the world, whatever sits underground belongs to the state, no matter who owns the land above it. Across large parts of the US, though, a private landowner can own the oil beneath their own backyard, lease it to a driller for a share of future production, and collect royalty checks for decades without ever operating a well themselves. An ownership structure that barely exists anywhere else on the planet. That gap in entry cost sets up the single biggest hidden multiplier in this entire industry, and it starts with a number most people have gone their whole lives without hearing. Saudi Arabia's state oil company can pull a barrel of crude out of the ground for something close to $9. Once drilling, extraction, and overhead are all included. That same barrel sells on world markets for anywhere from $60 to over $100, depending on the year. Picture growing a loaf of bread's worth of wheat for 9 cents and selling the finished loaf for 70 cents, then multiplying that gap across roughly 9 million loaves a day. That margin is why Saudi Arabia's national oil company posted higher annual profit in a single recent year than Apple, Microsoft, and Google combined. And why a sliver of its shares, just 1.5%, sold to outside investors for over $25 billion, in the largest stock offering in history. This gap between owning the ground and owning the paperwork above it is a genuinely old trick. In 1901, a British businessman named William Knox, the 500th Arsi, paid the ruler of Persia £20,000 in cash, another $20,000 in company shares, and a promise of 16% of future profits, in exchange for exclusive oil rights across most of the country for 60 years. Oil was struck 7 years later. By the time Iran nationalized the concession in 1951, the resulting company, later renamed British Petroleum, had paid the British government alone a striking figure, somewhere around $1.3 billion combined in profits and taxes. Iran, the country the oil genuinely came from, received a total of roughly $310 million in royalties over that same half-century. The paperwork once again out-earned the ground by a wide margin. That same asymmetry played out across nearly every oil-producing country in the developing world for most of the 20th century. until the balance flipped harder and faster than almost anyone expected. As late as 1970, Western oil majors still controlled roughly 85% of the world's known oil and gas reserves through concessions similar to Darcy's. By 1980, a single decade of nationalizations across the Middle East, North Africa, and Latin America had cut that share down to around 12%. Governments that spent half a century collecting royalties on someone else's terms spent 1 decade taking the wells back outright, and the entire structure of the industry has been rebuilding itself around that reversal ever since. A second, quieter layer of the hidden multiplier sits in the trading houses that move crude between producer and refinery. Almost nobody outside the industry has heard their names. Firms like Vital, Trafigura, and Glencore buy and sell physical barrels of oil without owning a single well, all headquartered in Switzerland, a country with no oil reserves of its own, a country that nonetheless handles an estimated 35% of the entire world's physical oil trade. Favorable tax treatment and light regulation pulled that business there over decades, and the arrangement has occasionally slid into outright corruption. Trading firms operating out of Switzerland have separately admitted to paying millions of dollars in bribes to secure contracts with Brazil's state oil company, and to buying oil from sanctioned regimes in defiance of embargoes. None of these firms drill a single well. They simply sit in the middle of the chain, and the middle of the chain turns out to be worth billions on its own. Winning the well only covers your entry fee. Staying in production costs you every year afterward, and those costs vary as sharply as the entry price did. Lifting costs, the ongoing expense of keeping an existing well pumping, run from a few dollars a barrel in the cheapest Middle Eastern fields to well over $30 a barrel in mature, played-out fields elsewhere. Every well eventually needs plugging and environmental remediation once it stops producing, a bill that can run into the millions per well. Refining adds its own layer of ongoing cost and margin, measured by traders as the crack spread. The gap between what a refinery pays for crude and what it earns selling the finished gasoline, diesel, and jet fuel that come out the other end. None of this shows up in the price of the barrel itself. All of it shows up in your margin. Insurance carries its own escalating price tag too. Tankers sailing through contested waters or sanctioned trade routes pay war risk premiums that can multiply overnight the moment a regional conflict flares up. An entirely separate cost layer that has nothing to do with the oil itself, and everything to do with the politics surrounding it. Trust costs money to manufacture in this industry too, even for companies that keep a spotless safety record. Major oil companies spend heavily on rebranding campaigns, solar and wind subsidiaries, and carbon-neutral marketing pledges. Spending that has little to do with the oil itself. Spending that has everything to do with staying politically acceptable to regulators, banks, and a public growing more skeptical of the entire industry. Skip that spend entirely, and a company risks losing access to insurance, financing, and drilling permits, long before it loses a single customer. It's optional in the sense that nobody requires it by law. It's mandatory in the sense that competitors who spend it quietly outposition the ones who don't. The risk that can erase years of profit overnight sits almost entirely outside any single company's control. And this industry offers two of the starkest examples of it anywhere in the global economy. On April 20th of 2020, the price of American benchmark crude oil went negative for the first time since futures trading began. Negative $37.63 a barrel. Storage tanks at the delivery hub in Cushing, Oklahoma were running out of room as pandemic lockdowns crushed demand. And traders holding contracts that required them to physically accept oil they had nowhere to put ended up paying buyers to take it off their hands. For one afternoon, the product oil traders spend their careers fighting to own became something people paid to give away. A decade earlier, a blown-out well named Deepwater Horizon killed 11 workers. It spilled roughly 134 million gallons of crude into the Gulf of Mexico. The company responsible, BP, has paid out something close to $65 billion in cleanup costs, fines, and settlements in the years since. A bill larger than the entire annual economic output of many countries, arising from a single well that malfunctioned over 87 days. A slower-moving risk sits over the entire industry rather than any single company. The possibility that global oil demand peaks and begins a permanent decline as electric vehicles and renewable energy scale up. Forecasters genuinely disagree on the timing and the scale of that shift. Some energy agencies project a peak within this decade. Oil-producing nations project steady demand growth for decades longer. Whichever forecast turns out correct, every dollar spent today drilling a well tells the same story. A well expected to produce for 20 or 30 years, carrying a version of that uncertainty baked into it from day one. An entire industry making multi-decade bets on a question nobody currently has a confirmed answer to. Revenue in this industry runs through three distinct layers that rarely get discussed as separate businesses. Upstream is the extraction itself, drilling and pumping crude out of the ground. Midstream is the movement of that crude, pipelines, tankers, storage terminals. A business built almost entirely on toll collecting, rather than ownership of the product passing through. Downstream is refining and retail, turning crude into the fuel, plastic, and chemicals that reach an actual customer. A company or country can own one layer, two, or all three, and the economics of each layer barely resemble the others. Sitting above all three layers is a cartel that behaves less like a company, and more like a group of shareholders who dislike each other. OPEC and its allied producers coordinate production quotas, each member agreeing to pump a set number of barrels a day, in order to hold the global price up. Saudi Arabia, holding the largest spare capacity of any member, traditionally plays the role of swing producer, cutting or raising its own output to absorb the slack whenever the group's math stops adding up. The arrangement works only as long as every member honors their quota, and members routinely don't. Smaller producers within the group have repeatedly been caught pumping well past their agreed limits, betting that the rest of the cartel will absorb the price impact of their cheating, rather than confront them directly. A version of the same free rider problem that undermines cartels in any industry. Geography hands a small number of countries an entirely different kind of leverage, physical control over the water the oil has to sail through. The Strait of Hormuz is a shipping lane barely 21 nautical miles wide at its narrowest point, between Iran and Oman. It carries close to 1/5 of the entire world's oil consumption every single day, with almost no alternate route around it. In 2026, when conflict broke out involving Iran, shipping companies diverted roughly 90% of their tanker traffic away from the strait within days. A figure that climbed above 95% once Iran threatened to strike vessels directly, sending oil prices climbing worldwide within hours. A body of water 4 miles wide at its narrowest shipping lane can move global fuel prices faster than almost any government policy on Earth. Layered on top of all three sits a mechanism most consumers stay completely unaware of. Since 1974, the vast majority of the world's oil has been priced and paid for in United States dollars. Under an arrangement struck between the United States and Saudi Arabia after an oil embargo had quadrupled prices within months. Every country that wants to buy oil needs dollars first, and oil exporting nations have spent 5 decades recycling those dollars back into American government debt. Around 80% of global oil transactions still settle in dollars today. A structural demand for the currency that has nothing to do with how the American economy is genuinely performing. Venezuela shows what happens when a country holds the largest asset in this entire industry and still ends up broke. By some measures, Venezuela's underground reserves are the largest proven crude reserves on the planet, larger than Saudi Arabia's. Yet the story since has gone the other way entirely. The country nationalized its oil sector and purged roughly 19,000 experienced employees from its state oil company, following a labor strike in the early 2000s. What followed was a loss of something crucial: the foreign partnerships that supplied the technical expertise its heavy, difficult crude requires. The result? Production collapsed by more than 80% within about 2 decades. A country that could have outproduced Saudi Arabia on paper ended up importing gasoline. Because owning the largest reserve on Earth means nothing without the pipes, the expertise, and the capital required to move it. That same lesson shows up again a few thousand miles north, through a completely different mechanism. American shale drilling boomed through the 2010s on borrowed money. Companies racing to lease land and drill wells faster than their wells could pay off the debt used to fund them. More than 200 North American oil and gas companies filed for bankruptcy between 2015 and 2020, owing more than $150 billion combined. Whiting Petroleum, once the largest oil producer in North Dakota, watched its stock market value collapse. From roughly $15 billion at its peak, down to $32 million, before it filed for bankruptcy in the spring of 2020. A loss of more than 99%. Venezuela lost its oil wealth to political mismanagement and a purge of expertise. American shale drillers lost theirs to over-leveraged debt and a commodity price that refused to cooperate. Two completely different causes, landing on the exact same lesson. Owning the resource is the easy part. Every country handles this differently though, and the difference is entirely a matter of institutions rather than geology. Norway struck oil in 1969 and built a sovereign wealth fund around the proceeds instead of spending them as they arrived, under a rule that lets the government spend only the fund's investment returns, always leaving the underlying principal untouched. That fund has since grown past $2 trillion, and now owns roughly 1.5% of every publicly traded company on Earth, worth close to $400,000 per Norwegian citizen on paper. Saudi Arabia, by contrast, runs its oil wealth directly through the state itself, using it to fund everything from public salaries to a sovereign investment fund of its own. Venezuela ran its oil wealth into the ground. Same substance, 3 governments, 3 entirely different outcomes, and none of it had anything to do with how much oil sat underground in each country. Weigh the whole picture plainly. At the small end, an independent driller owns real upside if a well hits. Alongside genuine exposure to debt, price collapses, and depleted fields with nothing left to show for the capital spent. At the state ownership end, a country holding cheap, abundant reserves can generate profit margins no private company will ever match, provided its institutions are strong enough to keep that wealth from being mismanaged, purged of expertise, or spent before it arrives. In between sit the private supermajors, diversified across upstream, midstream, and downstream, insulated from any single well's failure, but permanently exposed to price swings, environmental liability, and a public growing less patient with the entire industry every year. None of these positions is inherently safer than the others. Each one simply trades a different risk for a different reward. And the resource sitting underground plays close to zero role in deciding which risk you end up carrying. The institutions built around it always do. Go back to that valve in the basement, connected by hidden pipes to everything you own. Almost nobody who feels that valve turn ever gets to touch it themselves. The people who do aren't the ones who found the oil. They're the ones who built the pipes, signed the concessions, priced the barrels in dollars, and figured out, more than a century ago, that the ground itself was seldom the asset genuinely worth owning.